Hey y'all, it is April and it's tax season, which means it's time to review all of the wonderful myriad of ways in which owning real estate helps you pay less in taxes. One of the biggest reasons to own real estate as an asset class is to take advantage of the preferential tax treatments in the US Code for real estate owners. So what I'm going to do in this video is walk through a number of strategies. We have beginner, intermediate, and advanced strategies that you can take advantage of if you own real estate, even just your own primary residence. The first one, mortgage interest deduction. This is the easiest one. This is fruit so low hanging you probably would step on it. You get a 1098 every year from your lender that shows you how much you have paid in mortgage interest over the course of this last year. You multiply that by your tax bracket and bam, you've got a big number that you can use as a tax deduction on your filing. That's the easiest one. Should happen. Even a TurboTax is going to ask you for a 1098 if you own a property. So that should be pretty automatic. Next one, a little bit less automatic, but really helpful too, is the property tax deduction. So this is called the SALT cap, or the state and local tax cap. So any year since 2017, you've been able to deduct state and local property taxes from your federal returns. And that cap has been, I think, $10,000 up until this year. And that $10,000 cap was removed. So now you can go up to $40,000 worth of property taxes. So if you live in a higher tax state like California or some other West Coast states, that can be really helpful. Maybe not if you just own one property, but as you start to rack up multiple properties, since it doesn't matter whether it's a primary residence or an investment property, they're all treated the same. So that removing of that $10,000 cap in property taxes is big as your portfolio grows. The third one is depreciation. So your house, the IRS believes that your house minus the land will slowly degrade over time, over what they consider 27 and a half years, which, depending on how well your house is built, might actually be the case. But either way, the IRS gives you the ability to write off a certain portion of your house's value over every year of that 27 and a half years. And again, this is something that if you have a CPA or a tax preparer, they will do automatically. Even if you use TurboTax, this is something that should be done automatically. But that, 127 and a half value each year is a decent tax deduction. So the last one, this is something you use if you sell. This is called the Section 121 exclusion. So this means that your capital gains on your primary residence, you can get up to $250,000 for single, $500,000 if you are married filing jointly in capital gains excluded from taxes when you sell your primary residence. So that is a very big number. If you are planning to sell your primary residence and move to another house, then the gains from the time that you bought the house to the time that you sell it, you do not have to pay taxes on, which is a huge thing. So those are the four easiest, most basic tax deductions that we can use as property owners that everybody should be able to take advantage of. Next, we'll move on to our intermediate, our blue square strategies. Okay, let's take a look at the intermediate strategies that you can use as a property owner, primary or investment, to save money on your taxes each year. Now, these are a little bit more unconventional. Like, you can whisper about them in polite company, but you don't want to be talking about them out in the streets. So the four strategies we're going to talk about, the first one is a cash out refinance. Now you think, how does that save me on taxes? Essentially, because a cash out refinance is considered a loan, it is not taxable. So the basic strategy of make money, use that money to buy assets, and then borrow against that assets means any money that you pull out of a property is tax-free. So it's liquidity that you don't have to pay taxes on. You get access to the equity without triggering a sale. So you're realizing the gains without realizing the actual gains. So you get bonus points if you use this tax-free money to reinvest into another property, and then you get more interest to deduct as well. So number one, cash out refinance. Number two is real estate professional status. Now this is a little bit more involved, but if you work in some form of real estate, so that could be a contractor, it could be a real estate agent, title, there are a lot of different ones that fit under this umbrella, not lending though, weird, but you can be considered a real estate professional, and that allows you to offset an unlimited amount of passive losses. So passive losses are losses you could get from rental properties. So if you have, this works really well if you have a couple where one person is a high income earner, so somebody who has lawyer, doctor, dentist, whatever it is, and they are earning a decent amount every year, but they have a high tax liability. And then they are connected to somebody who is a real estate professional who can invest the money that the one partner makes into real estate and bring those passive losses against the active income from the first partner. So that's a real dynamic duo. Now, again, there are a lot of different careers that fit under this umbrella, but not all of them. But this is a great way to use one party and the other, again, to save a lot more in taxes. So when you are a real estate professional, the other strategy that you can use is number 3 is cost segregation and accelerated depreciation. So a lot of the value in your property can be depreciated again. So the IRS says anybody can depreciate over 27 and a half years, but a cost segregation study essentially says, yeah, there are parts of your house that are to degrade even faster than 27 and a half years. So your paint, your carpet, your flooring, other things like that are going to depreciate a lot faster than 27 and a half years. And so the IRS says, okay, if you do a study that breaks property down into these different buckets, then you can depreciate that even faster than you can over the 27 and a half years. So, and then there's an element to that called depreciation, which is something that the government has allowed you to essentially pull a lot of that depreciation into year one or two, and that can make a whole chunk of difference. So if you do this cost segregation study, and they can be anywhere from a few hundred to a little over $1,000 for a single family residence, then what they can do is they can accelerate a ton of that depreciation into year one, which again will save you a lot more in your tax liability. And then if you use those tax refunds and any money that you save to buy more real estate, and then you accelerate the depreciation on that, that is a huge rolling strategy that a lot of people have used to avoid paying taxes. So, but you can only do that again if you are a real estate professional. All right, the last one you can use, even if you are not a real estate professional, you can still deduct some passive losses. It's called the STR loophole, or short-term rental loophole. Now, this means you have to own a short-term rental. Step 1, it's in the name. Step 2 is that you have to materially participate more than anybody else in the operation or renovation of that rental. So you have to be active in it, but you only have to be active a little bit more than everybody else, including property managers, cleaners, etc. So there are some thresholds that you have to hit, but if you do hit that, then you can unlock some pretty large paper losses from your short-term rental. So this is great if you're a high-income earner. You don't have time to do all the real estate professional designation, but you still want to own a property, you want to own a vacation house, and be able to use a lot more of the write-offs. You can use the short-term rental loophole. It's not technically a loophole, but they call it a loophole. So those are the 4 intermediate strategies that take a little bit more intent to make happen, but can unlock a lot of things for you. So then we'll move on to our even more advanced strategies. So stay tuned. All right. Advanced strategies. Now we're getting to the good stuff, the stuff that is legal, but it still feels a little bit dirty to talk about. You know what I'm saying? So 4 strategies here again. Number 1, this is the 1031 exchange. So the best 2 times to pay taxes are later and never. And the 1031 exchange gets you a lot closer to both of those. So if you plan to sell an investment property, not primary, you can essentially transfer the basis. Remember we talked about depreciation, you have basis there. You can transfer that basis from one property to another through a 1031 exchange and keep you from having to pay those capital gains taxes when you sell that investment property. So this is taking Uncle Sam a little bit out of the loop. It's not eliminating the tax, but it is a tax. It is pushing it down the road, and the further down the road you get, the better. So a successful 1031 exchange does require a good tax professional. It requires a good qualified intermediary. So there are a couple of other parties that need to be in this. So don't just wing it on your own. And it's important to not overpay for a new asset just because you're going to get the tax benefit from the old one. So don't pay more than you need to, even though you're getting a good deal on taxes. So number 2, another way to get rid of a property and not pay taxes, at least right up front, is called an installment sale. So this is a way of owner financing. So instead of just selling a property, having your buyer take out a loan and pay you 100% of the proceeds upfront at closing, what you're going to do is create an installment plan. So essentially they're paying you over 3 years, 5 years, 10 years, whatever it is you want. And so this is a big help for the buyer, be a big help for them because they're paying less right now. What it does for you is, and you can even essentially take the money and put it into escrow and only take out a certain amount from the sale each year. And so that spreads your tax liability it spreads your capital gains and therefore your tax liability across a number of different years. So you're not paying it in one big chunk up front. So number three, and this is even more advanced, I think, than most people are willing to jump into. But if deferring capital gains is your goal, then opportunity zones can be your unders counter. They're their goal. This is a great thing to do if you've got a big property to sell or a business to sell or a big stock sale, anything like that. So what is a opportunity zone? So that wants to incentivize investment in certain areas of the country. They call these opportunity zones. To do this, they allow a sponsor of a real estate development to create a qualified opportunity fund. And this fund can take money from investors who are looking to defer some capital gains. So the investors put their money into the fund from the sale of their property, tax business, property, stock, business, whatever. And the gains that they get from that grow over time tax-free. So you have to hold this money in this qualified opportunity fund for 10 years, and then all the capital gains there are tax-free, zero, eliminated. So, and this is something that, again, the government supporting. So anybody who has a decent amount of tax liability can take that gain and put that into the qualified opportunity fund. Help build, revitalize a particular area. And these areas they're not all in the ghetto, they're in the hood or way out in the sticks. There are some that are like downtown Springfield, downtown Eugene, lots of other areas that you think would be just fine places to develop. The government has said, hey, we'd like to incentivize more development here. So this is a great way to build a lot of equity over time without adding to your capital gains. So advanced strategy number 4, the Augusta Rule. So this is literally named after people renting out their houses for the Masters tournament in Georgia every year. It's a carve out that says you can rent your property to your business for up to 14 days per year for company retreats, meetings, content creation, something like that. So if you have a business, an S Corp or an LLC, they rent the use of the property from you, and you charge them a market rate. And so your business gets to write off that expense because it's a business expense. So they use that to write down their expenses, and then you as the homeowner actually get that money tax-free as well. That's not counted as standard income. So you're actually having to pay money on it. So it's kind of a double dip, but the IRS says it's good. So we also say that's good. But again, you have to own a business and own a house that is worth meeting in or filming content or whatever in. So up to 14 days a year, you can do that. So those are 4 advanced strategies, again, they take a little bit more, a few different parties to make work. But again, want to avoid taxes, these are great ways to do it. All right, a couple of bonus things coming up. Bonus strategy number 1. This is called swap till you drop. So we talked about deferring taxes out as far as you can down the timeline. So the time value of money means that tax is actually worth less if you push it out as far into the future as you can. But at some point, there's a certainty in life. Taxes, maybe not so much. Death, yeah, still haven't figured that one out. So there's a way to use death, yours specifically, to get out of paying taxes. So if you've been successful in deferring taxes down the road to the point where you're close to death, you've been doing a great job avoiding taxes. So now you have a really low basis. So you have a high value property with low basis. It means if you were to sell it, you'd have a large capital gains. So if you were to pass this down to your heirs while you are alive, they are also going to have a low basis, high value property. But what the IRS says is upon your death, the inheritors of this property get what we call a step-up basis. So they go from low basis to high basis, and this can happen with real estate, stocks, or businesses. If you pass down after your death, your heirs get a step-up basis. And that means that the capital gains that you would have had to pay are effectively eliminated. That resets the clock on capital gains, resets the clock on depreciation, so your heirs can use that property that you have given them they can either continue to manage it on their own, or they can sell it and not have to pay that capital gain. So the IRS is nicer to you in death than you are in life. So when you combine a 1031 exchange to defer that tax liability down the road, you can essentially pass down assets and entire tax-free. So it is the cost of it is a little bit high, but if you're able to die well, then you just will not have to pay a lot of tax on the property that you leave them. So that's advanced strategy number one. Advanced strategy number two, double black diamonds. Now this is again, a little bit more detailed, but very useful for somebody in a certain time of their life. So what happens is a lot of people, either when they get older or their kids move out and they are left with a big house, they may want to relocate. They may want to downsize to a smaller house, to a nicer location, maybe a house by the beach. Often what happens is they will sell their primary residence and just use their Section 121 exclusion that we talked about already to buy the house on the beach. But if they own an investment property, they just continue to own that investment property. So what we want to do is move those things around a little bit more efficiently and avoid having to pay any capital gains, say, on that investment property. So what happens is, and this is going to take about 2 years to do it, but what you do is if you want to buy, say, that beach house, you want to downsize, buy the beach house, but you already own an investment property. What you do is you sell the investment property and you 1031 that tax basis, that money into the beach house. You hold that beach house, you use it as a rental, short-term rental, investment, whatever it is. You use it for 2 years, and this is to stay on the good side of the IRS. You use it for 2 years, and then you sell the personal residence. Again, you use the 121 exclusion. You sell that personal residence, and you get to keep all of that capital gains, all that money tax-free. So now you move into the beach house, but all the gains from your primary sale, you've used the 121 exclusion, so you don't have to pay any tax on that. Use the cash to do whatever you want with, buy a boat, buy, I don't know, whatever it is you want to do. You've got a lot of money, do what you want with it. I'm not going to tell you how to live your life. But this is a way where you get a much better tax scenario. If you have an agent, sales out of it, everybody's happy, but you're paying a ton. You may pay a little bit more realtor fees, but you're going to pay a ton less in taxes. So you're happy. That doesn't matter. So that's advanced strategy number two. I don't really have a good name for it, but it's a very powerful one. So this is a quick overview of different tax strategies that you can use as a real estate owner, whether primary or investment property, to pay less in taxes every year, this year to the end of your life, and possibly even further than that. So take advantage of these. If you have any questions, pop them in the chat below. Always happy to talk. Again, my name is Chris Watkins. Always happy to help with mortgage, real estate, finance questions. I love talking about this stuff. So reach out and let's do it together. Bye.